Welcome. Glad to have you all on this webinar presentation talking about year-end tax planning for 2023. Can you believe the year's almost coming to a close? It's very hard for me to believe, but we're at the end of November, maybe December if you're watching this from recording. So certainly glad to have you tune in as we wrap up the year from a tax planning perspective. First, I want to introduce us. If you're new to who we are Financial Freedom Wealth Management Group, or you might see the initials FFWMG. We were founded in 2001, and we are a comprehensive wealth management and planning firm committed to helping our clients improve their long-term success and pursue financial freedom, which is a great pursuit, and we help people every day in this, which is great. And you can see who we serve, a number of people. It usually falls into these three categories: pre- and post-retirees wanting to build and protect their wealth, people developing and growing their wealth, and then also business owners that are needing financial services. So that's who we help out and focus in on. And then our commitment, so this is, company-wide, we are here to care deeply about you and your financial life. So that is if you can sum up all that we do, that's it, is to make sure you're taken care of for the rest of your life. And your family's life too, so it's a good thing. Here's our team. We have a total of 22 on our team. There's a couple new ones that aren't featured here yet, but their pictures will be up there soon, we promise. We have 6 financial advisors readily available to help you, as well as 16 support staff, 2 of which, by the way, are becoming advisors in the next month or 2. So that is very exciting. We love to see the growth of the team. And then also the whole point is really to serve our clients. So that's the beauty of what we do and of who we are. So we do want to say that throughout this presentation, we want to get your questions. So if you have something as we're going through the content here today and you want to ask it now, go ahead and text your question to our main number here, which is 458-777-4458. And this will be on the bottom of most of the slides as well. So you don't need to write it down if you don't want to. We're gonna have it available for you as well at the end. But yeah, if anything comes up, ask that question. And at the very end, we will go through those and answer as many as we can. And there is, as you text in, there's no need to accept anything. You're just gonna get a disclosure statement saying that we've received your requests. But yeah, go ahead and text those in as you have them. And then let me introduce Julia, who is going to kick off the first part of our session today. Julia is the founder and CEO of Financial Freedom Wealth Management Group. She founded it in 2001. She is the actual founder, which is pretty cool that we get to hear from her. She's a great thought leader in the industry. She's been on many different interviews and podcasts and all sorts of things. Julia, you are an entrepreneur and a speaker, an author, an educator. I don't know if there's a topic you haven't covered or dove into within our industry. Well experienced across our financial landscape. And actually, Julia specializes in the tax strategies, which is why we really wanted to make sure she was part of this presentation, as well as exit planning strategies for business owners in particular. So those are her specialties, but there's been many awards given out. I won't go through the whole list, but I imagine you can find them on our website. But very involved in the community there in Newport. I know you're part of Rotary, Chamber of Commerce. You also serve with the Pacific Communities Health District Foundation on their board, which is amazing. And I know you also have a wonderful husband and 3 amazing children, which are growing up very quickly on you. So when we talk about success, Julia, you are not short in that department. So welcome.
Thank you, Jason. Well, you're right there with me. So let me talk about Jason a little bit, because he's going to come back after I talk about taxes one of my favorite subjects to talk about. But then Jason's going to come back and talk a little bit more about some other year-end planning ideas and what we can do before the end of the year. So Jason is our certified financial planner professional. He is also the president of Financial Freedom. So I could not be the leader of this company without Jason. He just ensures that everything runs smoothly and takes care of our amazing team and staff. And so grateful to have you as my partner. Jason graduated from Oregon State University. So go Beavers. Got to send some love their way after the last game.
Yes.
And he received his MBA in finance from Walden University. Jason has substantial experience in financial systems and money management. His extensive experience empowers him to be able to be quickly adaptable and understand all of the challenges that are thrown our way in the financial industry. He also loves spreadsheets. So another thing where I can say, hey, Jason, fix this. Jason plays an active role in the Corvallis community. His office is right there on 3rd Street in downtown Corvallis. He's awesome part of their community. He has a wonderful church community that he serves, as well as various boards and finance committees. So he is pretty hectic in his business life, as well as his children, who are parallel to mine. So I know that you know that, yes, the kids are growing up quickly.
Yes.
And has a wonderful wife, Angel, as well. So we're looking forward to hearing more from Jason too. Okay, so let's dive in. So when I think about taxes, this quote always comes to mind from Benjamin Franklin. In this world, nothing can be certain except death and taxes. Yes.
Yep.
So the tax season is right around the corner, like you shared, Jason. I can't believe we're looking at the end of 2023 and 2024 will be here before we know it. So I will also share, I know in the coastal community of Oregon, and I have heard in other communities around the nation, actually, that we have a shortage of accountants and CPAs and tax preparers. And so I am happy to share that we have a sister company, Freedom Tax, and we have been working on enhancing the team and adding team members to actually help serve financial freedom clients and getting their taxes prepared and completed. So if you need tax help for 2024, filing taxes for 2023, please let us know and we can help you get in touch with them. So that's exciting news. All right, next, if you are an Oregonian, I am sure that you've probably heard about the biggest kicker in history for Oregonians. 44% of the taxes that you have paid, if you have paid Oregon state taxes, is actually coming back to us as a refundable credit on our 2023 tax returns that will be filed next year. So my guess is there's going to be a lot of people coming in early to file taxes to get that money back. So if you're curious of what your tax kicker is, you can actually just go to Google, your favorite search engine, and type in Oregon Tax Kicker 2023, and you will be able to just put in your information and they'll actually tell you what your credit you have coming is. So be sure to go do that. Okay, so let's see where we are landing for our 2023 ordinary income tax rates and the tax brackets. So as all of us probably know, US has a progressive tax system, meaning people with higher taxable income pay higher federal income tax. But also keep in mind that the tax brackets are representative of how much you pay for each portion of your income. So for example, if you are a married filing jointly household and you make $100,000 of taxable income for 2023, you would look at this chart and you would say, okay, that 100,000 falls into the 22% tax bracket. But that doesn't mean that you're paying 22% on all of your money. So what you would find is the first 22,000 you pay at 10%, the next $67,449 you pay at 12%, and then the final $10,059 to total $100,000 you would pay at 22% tax bracket. So your effective tax rate, if you have heard of that term, is the blend of what your true tax rate is percentage-wise of your income. All right, so here we have 7 tax rates currently in the United States. And then you can, whether you're single or married filing jointly, you can find your number in there. Now, also keep in mind, you want to look at, this is your taxable income. So your taxable income is after your standard or itemized deduction. Okay, so we're going into 2024 here, and there's some potentially big changes happening in 2025. So we're getting very close to the sunset of the 2017 Tax Cuts and Jobs Act, or I'm going to refer to this as TCJA, maybe. I'll just say the Tax Cuts Act. So what that means is on the left-hand side, the left-hand column is what the tax rates were before this act went into place in 2017. So as you can see, basically, if you made over 400 and it looks like about 75,000, you were in the top tax bracket at 39.6%. And if you follow that over to the right-hand side, right now, since 2017, you have had a tax break of about almost 5% there, and you're only paying 35%. So at the end of 2024, if Congress does not act, so if nothing needs to happen, and these will all expire at the end of next year. So it doesn't impact the next tax season, but it will impact further. So we do need to start planning and thinking about, is there anything we need to do in 2023 before it's too late, or 2024 to take advantage of these lower tax rates we're in right now? On average, it's about a 3% tax cut that we're experiencing right now. So for the majority of Americans, they fall in that 12% tax bracket, which will default back to the 15% bracket in most cases. Okay, so the 2024 election year, we're going into an election year, and this will likely impact how the expiration of this Tax Cut and Jobs Act plays out. However, even if one party gains unified control of lawmaking, there is no guarantee that the provisions of this act will simply be extended. The makeup of Congress, as we know, changes over time, as do the priorities. So it's important to, at where I sit right now, I would say most likely we need to plan for this to expire. The Congressional Budget Office recently forecasted the cost of extending this provision. So if they put it permanent, that would cost over $3 trillion over the next 10 years. So that is in addition to all of the money that's been spent as well. So you can see by allowing this to expire, it actually helps the deficit moving forward. So I think there would be some pretty strong cases for just letting this expire and allowing that budget to help balance in the future. Yeah. Okay, so our ordinary income tax rates that we just discussed are very different than capital gains taxes. So with the law changes that have happened, the capital gains taxes have not changed. Okay, so that's a very important detail to keep in mind. So in this chart, we focus on long-term capital gains. The highest earning taxpayers will still have a 20% tax rate on long-term capital gains. And those in the lower tax rates, so you're either in a 15% tax rate or potentially a 0%. So if you're in that 12% tax bracket and you have capital gains that don't put you into a higher tax bracket, then your capital gain rate is actually 0. So it's, again, another tool to understand as you plan for thinking about ideas of what to do with your finances before the end of the year. Also, this chart does not include tax or state taxes. So for example, if you're in Oregon, the capital gains rate for Oregon is 9%. And as a reminder, you must hold an asset or a security for at least 12 months for that to qualify as a long-term capital gain. So if you don't hold it for a year, then it's going to come out as a short-term capital gain. And that means short-term capital gains are subject to ordinary income tax. So you want to beware if you're looking at an asset that has appreciated, make sure that you've held that for at least a year before you sell it. So this could be a stock, mutual funds, real estate, cryptocurrency, like any asset out there that would potentially have gains. Okay. And I will also share that ordinary dividends are treated as ordinary income. So your investments, mutual funds, bond mutual funds, stock mutual funds, stocks, all of those, the income off of that is taxed differently depending on the type of investment it is. So typically, US stock dividends are what we refer to as qualified dividends and are subject to these capital gains rate, which is typically better than your ordinary tax rate. Lots of information here. So I want to encourage you that this general information today, because we can talk about a lot of things that are cool and exciting, and maybe you should take advantage of some of the ideas, but I would also put out a disclosure. Make sure you're talking to either a financial advisor, your tax professional, your CPA. We can help you get answers and look at what would be appropriate for your exact situation. Because we just you want to know your tax bill and not be surprised by it. I'll just say that. Okay, next, the 2023 standard deduction. So most Americans now will take the standard deduction instead of itemizing. So for 2023, if you are single, it's $13,850. If you're married filing jointly, $27,700. And if you're over 65, you'll get an additional amount as well. So those are you have to have quite a bit of itemized deductions to surpass the standard deduction. Okay, so let's talk about some opportunities that are available to us before the end of the year. So Roth conversions are a very popular topic, and I think even more so because we're facing this potential sunset, the expiring of the tax laws. So does it make sense to move money from a traditional IRA into a Roth IRA? That is a Roth conversion. So anyone can do a Roth conversion. But the big red flag is when you do the conversion, the amount that you convert is taxable in that year. So the deadline for the tax year is 12/31. you want to make sure you don't just do a conversion without thinking of the tax consequences. We need to make sure it makes sense for your tax situation, as well as your long-term financial plan and your beneficiaries and what you want to have happen in the future. So does it make sense for you to pay more taxes now for then this to grow? The benefit is once you get that money into a Roth IRA, it grows tax-free and on tax-free to your beneficiary. So there can be some very compelling reasons of why you want to do this, but you also have to remember it means you're paying more taxes now. A little, I would say a little trick, if you will, if you want to look at this, is if you are in the 12% tax bracket, and let's say your income is $10,000 below the top of the 12% tax bracket that we just looked at. To us, that would say, okay, you can move $10,000, still be in the 12% tax bracket, shift that over into a Roth IRA, pay taxes, but then allow that to grow tax-free. So for us, if you're in 12% or lower tax bracket, there's usually a very compelling reason to do a Roth conversion. So just, but reach out to us. That's why we're here, to help you to figure out what is best for you in your personal situation. I like to say personal finance is personal. Okay, next. Now this tax loss harvesting relates to non-retirement accounts. So if you don't have non-retirement accounts, like if all your money is in retirement accounts, you can take a little nap right now. But if you invest money in a non-retirement account, you got to pay attention. Okay, so tax loss harvesting is a strategy to help lower your current federal taxes by selling an asset that has a loss to offset taxes you may owe on capital gains. So let's say you have two different stocks or two different mutual funds in your portfolio. One made money, one lost money. So what you can do is you can sell both of them, move into a similar type of investment, and realize the gain and loss so that they offset each other. The advantage to that is you increase your cost basis tax-free because they're offsetting each other. And then when you go to sell it in the future, you have a higher cost basis. Therefore, it wouldn't be as much taxes. So usually you want to, usually this makes sense if you have a bigger estate and you have quite a bit of gains and losses to harvest. So again, I think this is very important to look at your individual account with an advisor, and we can help guide you if this makes sense for you. Okay. Some other things to think about before the end of the year are contributions to 529 accounts. Those are the college plans. If you have those have a 12/31 deadline, as well as contributions into your employer retirement plans, and then the required minimum distributions if you are over 73. And I know Jason's going to talk more about that as well. Okay, so let's talk a little bit about how estate taxes work. So at death, all of your assets are totaled for calculating what we refer to as your total estate worth. Anything over what we refer to as the exemption amount is taxed at estate tax rates. So I'll share on the next slide what those exemptions are. For federal, it's very big, but for Oregon, it's $1 million. So basically, once you have over $1 million of estate value of assets, you want to start thinking about how do we do some tax planning for your beneficiaries if that's important. Also, it's important to note that retirement accounts, unless it's a Roth IRA, because those are already after tax accounts, but retirement accounts are always taxable to your beneficiaries after you pass away. It's taxable when the money is actually distributed, unless it's to a charitable institution. Okay, beneficiaries have 10 years to take the money out of beneficiary IRAs. So in the past, beneficiaries used to be able to stretch it out over their lifetime, but now that option is no longer available. So again, just some things to consider with estate planning. So the current federal estate tax exemption is $12,920,000. Now, with the sunset provisions of the Tax Cut Act, it is actually going to revert back to $5 million. So we're going to lose about $8 million of exemption per person, again, if things don't change. So this is a use it or lose it opportunity. So what do I mean by that? What I mean by that is if your estate, the size of all of your assets, if it is over $5 million, then I would consider either some advanced estate tax planning techniques that we can help you with, or it could be as simple as start setting up 529 plans for your kids and grandkids, potentially gifting some of your stock. We see this happen a lot during the holiday season. And there's limits to it. So Jason's actually going to talk about those limits. But this is something to consider. If you have a larger estate, how do we start rearranging things to use this exemption before it goes away? And then lastly, if you're in the state of Oregon, Oregon has $1 million exemption. So two partners would each have a married partnership would have $1 million each spouse. So if one of them dies first without any planning, the spouse that is left is going to have $2 million. So if they haven't done planning, 1 million is an exemption, but then the other million is going to be taxable. So there's some simple strategies that you can use and put into place to ensure each partner gets $1 million exemption, and it stays when one partner passes. So again, we're happy to help you think through those strategies for you. All right, here the estate and trust tax rates are pretty high, and they get pretty high pretty quickly. So you can see, and this is not, if you have a revocable or a living trust, this is not, that's not what this slide is talking about. That would actually flow through and taxed at your rate. This would be if there's a trust that it's its own entity, it has its own Social Security reporting, and it's separate from your estate. So essentially after you pass, if they keep the trust going, this is the tax rate. So you can see if the trust makes over $14,000 of income, it is in the highest tax bracket, 37%. So that happens very quickly, and will go to almost 40% when the sunset provisions, if the tax cuts expire. So really important to think about your long-term estate plan. If it includes a trust moving forward, how do you make sure to mitigate the taxes? Okay, with that, I am going to send it over to Jason. I will also say, if you have any questions about anything I just talked about, please again text those, and we will come back and answer any questions at the end of the webinar here.
Great, thank you, Julia. That's a power-packed moment of taxes for us. Greatly appreciated. And I know you were holding back. There's a lot more that we have that we could share, but we only have a limited time right now. So you're exactly right for that. Let's talk a little bit about charitable giving. There's a few strategies we want to talk about as we close out the year. One of them is, if you're going to name a charity, consider, consider naming the charitable institutions as a beneficiary on your retirement accounts. So be specific with that, because when it's on the retirement accounts, it's actually going to be tax-free to the nonprofit and not a taxable situation for your heirs. So that's why if you were planning to have a charity inherit part of your money, it would be good to do it that way. And obviously you can see the exception there is for Roth IRAs. So again, specific to Roth, that's best left to the kids or to your family, because again, that will keep it tax-free when they're inheriting it. Then generally you will want to name your family as a beneficiary to your living trust or your non-retirement based accounts. So under current law, if you name your family, like people, as beneficiaries on that, they will receive a step up in cost basis, like Julie was talking about earlier. In other words, you will not pay, it'll be that new starting point for paying taxes at that level. Also, when gifting to charity, it's best to donate things like appreciated stocks, bonds, mutual funds. Instead of selling them and then gifting them, gift the shares directly. That way you end up saving on taxes. And it really eliminates that need for you to pay the capital gains tax on the sale or transfer of those investments. And you may also be able to get a tax deduction for, like, if you gift property, so that property's fair market value, if you gift it to a qualified charity, that may also qualify for a tax deduction. So let's talk about another strategy with charitable distributions called qualified charitable distribution. So at the end of 2015, Congress made this law permanent, that you can basically gift IRA money direct to a charity. So from your IRA, it goes straight to the charity at the wonderful age of 70 and a half. Now, I thought we stopped counting half birthdays when we were about like 5, but it continues with the IRS. 70 and a half is your magic number still for qualified charitable distributions. And you can do that so as early as 70 and a half and up to $100,000 per year, you can gift direct to the charity. So if you are 73 this year, so that's again the new required minimum distribution age, RMD age is 73. I know they keep changing it on us, but that's the that's the one for this year and moving forward until it changes again, but we'll tell you that later. So if you're 73 this year, you can actually have this QCD count towards your RMD requirement. So in other words, if you had to take out $20,000 for your RMD, you can actually send that $20,000 direct to your charity from your IRA, and then that $20,000 counts as your RMD, and of course you don't have to pay taxes on it because you're sending it straight to the charity. It's really a great way to do it. And as you can see, so the QCD lowers both your adjustable gross income and your taxable income. So that results in overall lower tax liability. And since you have charitable intent, which I'm assuming if you're paying attention to this part, that's part of what you're trying to do, that satisfies that as well. So it's actually a double benefit. And here's what's even greater. You do not have to do itemization on your taxes to make this happen. It just automatically does it. So I will encourage you, though, to talk to your CPA or whoever's preparing your taxes, or to our team if you want some advice and help on this. There are some ways you have to do it. So if you're in the RMD time frame and you do some RMDs early, it can kind of mess this whole thing up. So you'll want to do this as your first distribution before you take anything else that's required for you. And again, this is another thing where you have a December 31st deadline to do this. Same with your RMDs. If you're 73 this year and haven't taken that yet, you got to do it before 12/31. And for QCDs, that check really needs to clear. So don't wait till 12/31 to write the check. You want to write it now, essentially, and make sure everything gets processed. That way you don't have any issues with the IRS. So that will be important. Okay, then you also have an annual gift tax exclusion. So for 2023, you're able to give $17,000 to anyone without tapping into your lifetime gift exemption amount, which Julia had shared earlier. So what's nice about this is it doesn't require you as the giver to file any sort of a tax return for this, because no gift taxes are due. So there's nothing to file. You're just gifting up to $17,000. And again, this is adjusted for inflation. So like next year, it'll go up to 18,000, but for 2023, we're at 17. So here's a cool example. If you're a couple that has 3 kids, I know somebody like that, both people can can gift $17,000 to any person. So let's say you want to gift that to your 3 kids. Well, each of you can gift $17,000, which is $34,000 to one person. And if you've got 3 kids or grandkids you're trying to gift that to, that's a total of $102,000 that you can gift without any tax filings or ramifications, which is pretty neat. And the recipients don't have to do anything in terms of filing things for their taxes either. So now you can gift more than that. And what that would do, it doesn't necessarily mean you're paying taxes. It just means that that's going to start tapping into that lifetime gift exclusion, which was that 12.9 million that we just talked about. So you tap into that, but it just lowers that exclusion amount. One other thing to note with the gifts, you can also gift directly to things for qualified medical, for example, or dental, tuition payments. If you pay that direct to the place, let's say if it's a school, for example, or a medical office on someone else's behalf, you can pay that direct, and that will not count towards your annual or your lifetime gift exclusion. So some pretty cool things that you could do if you're just trying to help some people out and be charitable. Okay, let's talk a little bit about 401k and IRA, Roth IRA increases. And again, if you're having any questions, feel free to text those in. This is our last main segment here. So let's prepare for 2024. It's getting so close. So what's going to happen is that 401k plans and most retirement plans are going to increase the deferral maximum to $23,000 next year. It's currently at $22,500. And then for IRAs, traditional IRAs and Roth IRAs, again, that's a separate bucket that you can do. Those contributions will increase to $7,000 next year. It's currently at $6,500. Oh, and by the way, if you're 50 or older, then you can add $1,000 to this IRA contribution, $1,000 for next year. Well, and actually for this year and next year. So 7,500 or 8,000 for next year, which is great. And then on the 401k side, if you're 50 or more in age next year, then you can actually add 7,500 more per year. So this year it would be 30,000, and next year it'll be 30,500. So a nice little increase that you have the potential to contribute as a catch-up. Okay, so next steps. Where do we go from here? There are so many strategies, so many ways that you can implement these tax situations and look at your specific situation, the personal side. I like that. So we'd love to offer you a complimentary consultation. You can text the word freedom to the same number, 458-777-4458. And we'd be glad to review your situation with you and make sure everything's aligned. Also work with your CPA or a state attorney. Those sorts of people usually need to get involved as well. And obviously, if you're already a client, you can always just let us know, hey, I want to review some of these things. We'd be glad to do that with you. And if you're not a client with us yet, we'd be glad to help you. Just take a look, no obligation to do anything, but at least help get you on the road for your financial future and make sure that's all secure and doing well. So if you do still have questions, I'll allow you to put those in to text us at 458-777-4458. And then we'll go through a couple of more housekeeping items here. The first one is that we do we do work with a broker dealer is what it's called LPL Financial. So they're actually the largest independent broker dealer in the nation. What we like about them is that they have no proprietary products. So a lot of people haven't even heard of LPL Financial. It's because they just kind of work behind the scenes to make sure we're taken care of so that we can take care of you. And they also have account protection up to $500,000 in SIPC coverage, plus additional private insurance for $575 million. So quite a bit of protection for your accounts, which is very great. And then I do want to share these disclosures as well while you're texting in your questions. Take a look at that. And let me start pulling up these questions here. Okay, keep them coming in, but we do have a couple here already. So question, if I make a profit from a short-term stock at, let's say, $100, is that taxed at 15%?
So it depends. So on any short-term gain, which this would be, it would be added to your other ordinary income that's made in your family, or if you're single, just yours, or married, filing jointly together as a family. So it depends. If we look at that chart and you're at 100,000 and this takes it to 100,100, you're going to stay in that 22% tax bracket. So just that $100 would be charged 22%. So is that clear, Jason?
Yep.
Yeah.
Yeah, that makes sense.
Where if
a lot of it.
Go ahead.
Well, a lot of it just depends on your tax bracket, really.
Correct. So you have to add it to your other income and then see where you fall in the tax brackets. We will also send this recording out with information that shows the tax bracket. So that way you can have a guide to look at it and see where you fall.
Mm-hmm. Okay, next one. Why is giving stock preferable over money?
Ooh, good question.
Good one.
You want me to answer?
I'll start and then you can
Okay.
add in anything extra. Yeah, so it's really that appreciated stock. If you gift it, then you're not paying the tax on it. And then the receiver, if they choose to sell it, they can sell it and not, I mean, it'll be taxed at their tax rate. So they'll pay a little bit of tax on it possibly. But yeah, that way you have reduced your taxable burden and of course your longer term estate. And then you have the money, it has gotten to the place that you want it to go without a tax situation.
Yeah. Good. It's usually a little more work than writing a check, but
It is.
worth it.
Yeah.
And most nonprofits have some sort of investment account that they can accept it from. So it's really working with your financial advisor and the nonprofit's financial advisor or their institution. And it actually can be done electronically between the two, but it's just doing the homework of getting the information. But usually executive directors, the nonprofits, they know that this happens and have the resources to provide to us. So
That's great. All right, we have another one here. What are the contribution limits for HSAs, that's health savings accounts, in 2024? Ooh, that's a good question. It will actually be increasing again. It's indexed for inflation. So if you're an individual, it will go from 3850 to 4150. And for families, it's going to go from 7750 for the year to 8300. So quite a big jump. And then you'll still have the catch up of $1,000 if you're 55 or older. So that's another little piece. We also have a guide that I think, Julie, this is what you're referring to, but on our website, there's a guide for the tax year, and we will have an updated one with the 2024 numbers that anyone can access at any point in our references on our website.
Jason, I'm so impressed. You had that information right there. Good job.
Got at the tip of my fingers. Thanks to our amazing team. Great. Okay, that is all of the questions we have now. We're going to give it just a couple more moments because sometimes it takes a little moment to text those in.
I have a thought I wanted to share.
Go for it.
Yeah, when you were talking about, because I think this is really, if you are as a married couple getting over $2 million, I think this gifting the up to the $17,000 limit that Jason talked about is really something to think about with your kids or grandkids. And often what we see is that's an opportunity for us to get involved in helping educate that next generation. And so oftentimes you don't have to just give them money. You could do the same thing that we talked about with a charity, where you actually gift them positions that you hold in your portfolio, and you set the kids or grandkids up with an investment portfolio, and it actually starts helping them understand investments, why it's important to hold on to these, the time value that investments, like the biggest thing about investing success is time and patience. And so you're really transferring that gift to them, explaining how you have accumulated these assets over the years. And I think if you can provide or allow us to provide the education with that transfer of gift, it's actually setting them up for success, as opposed to maybe someday you pass away and then they find out you have millions of dollars. So often they're not equipped at that point. And our parents, like, we want to look to our parents for wisdom. We want to look to them as that example. And if you do a little bit over time while you're living and you get to see the fruits of that, they're actually held, I have found they're held a little bit more accountable to that process, as opposed to getting everything when you're gone and not really having any sounding board to talk about it. So just some thoughts there, that it could be a gift of becoming an investor for your kids.
That's great wisdom. Okay, looks like we have two more questions here. First one, will I be taxed at a higher rate for my 1099 position where I received commissions of over $6,000 for the year?
So my guess is this is like self-employment income.
Correct.
Right? Okay. So again, that would be added to your ordinary income. And you would follow the tax bracket that you're in to understand how you're taxed at that. But then you're also going to be taxed self-employment tax. So you'll actually have a schedule on your tax return. So you want to make sure if you had any expenses that you incurred that for that $6,000, you want to make sure you deduct those, because that the net amount, like, so if you had 6,000 and you had some expenses, so your net was only 5,000, you're going to pay taxes on just the 5,000. So it's important, if you are an independent contractor, to keep really good records of receipts. You know, almost all of us use our cell phone for business, like, you know, things like that, that you wouldn't maybe think about deducting, you can deduct against that income.
Okay. Okay, here's another one. This is about annual gifts. What qualifies? Is this just money or charity, or will a new furnace qualify?
Maybe they mean like, if my kids' furnace go out, can I pay for a new one? I think they mean that. Is that right? Tell us yes or no. Yeah. So two different things, right? So money to a charity is unlimited. It's not subject to the $17,000 limit. The gift to other people, like your kids, grandkids, that's what's limited to 17,000 per year. So it's either cash value or investment value, or if you're paying for something, you know, that value.
Right. Okay, we've got another one. Can you elaborate on giving stock versus money as a dollar, maybe dollar amount example?
Ooh, okay. I have a good one.
Go for it.
Good example. Okay, so let's say someone invested in stock 10 years ago, and they purchased it at $10 a share. And now it's $100 a share. Okay, so their $10,000 investment went to $100,000. And they want to use part of that money to give to their favorite nonprofit. So let's say they want to give $10,000 to their nonprofit. So instead of coming to us and saying, hey, sell, how many shares would that be? 100 shares?
Yes.
Yeah. So, you know, sell $10,000 worth of stock, so then I can give it to my charity of choice. That would result in you paying a pretty big capital gain on that, because it's almost, you know, 90% of it is capital gains. So instead, you could go to your favorite charity and say, hey, I want to gift 100 shares of this stock to you. And then you would give those instructions to us, and we would work with that nonprofit, or you would work with that nonprofit to give us their information of their stock account, and we move it electronically from your account to their account. And then on your tax receipts, you would just prove that you gave in kind, like you gave this stock valued at X dollars when you made the gift, and that would be a deduction for you, as long as you itemize.
Mm-hmm. Yeah, again, a little more complex, but saves you quite a bit on taxes and satisfies that charitable intent.
Yeah. You guys have lots of good questions.
Yeah, and there's one more. This
Okay.
might be the last one, looks like. If I have $50,000 in interest income, assuming ordinary, married filing jointly, then
Could
I
I?
might have messed this.
Yeah.
Then okay, could I sell the stock with $40,000 in long-term capital gains and have 0% capital gains rate?
So I think I get that. So what would happen? So $50,000 is ordinary income. So you're saying that's your other ordinary income. Now I'm going to sell something and I'm going to have $40,000 of long-term capital gains. So your total income is $90,000. And then I'm going back to my chart to look at, so the top of the 15% bracket is $89,250. So if you truly had 50,000 and 40,000 gain, that would be 90,000. But then what happens is you take your standard deduction, which is at least 27,700 that comes off of that. And that would keep you in the 0% capital gain rate. Did that make sense, Jason?
Yes.
So you're
the deduction comes off of the capital gains rate.
You're getting really technical with me. I think so. We know enough to be dangerous here.
Yes, yeah, we would definitely, we could find that out pretty easily, but yeah, there is a risk. I mean, the thing to know is once you start getting to that level, once you cross it, it is the full 15%. So if you do end up crossing that line, you're going to owe the 15% on the long-term capital gains instead of the 0.
Yeah, but I'm thinking about this. So even if the standard deduction would definitely come off the other income.
Okay, yeah, I just got confirmation. The standard deduction does come off. So you were right. It'll be 0%.
Yeah.
There we go.
Question.
That was a great one.
It was. All right. Well, we are coming up to the top of the hour. So thanks everyone for hanging out with us today and talking taxes. We are here for you. So if you want to talk about your individual situation, reach out to us and we're here to help. Any last thoughts, Jason?
Thanks for tuning in. Have a great rest of the year.
Okay. Happy holidays, everyone.
Bye.